Welcome to the 21st Veteran ETA Roundtable. Great to be back with you all. Great to see some new faces as well as some regulars here. As always, just a quick little disclaimer that none of this is legal advice, but really excited for tonight to have Goran Pavlovsky here with us to talk about the new SBA SOP. Just quick little bio on Goran. He is the CEO of AWG Capital Advisory, which is a firm that delivers financing solutions to entrepreneurs, independent sponsors, and search funds, targeting businesses with enterprise value from the $1 million to $50 million range. In this role, Goran helps clients secure tailored debt solutions for acquisitions, buyouts, and growth. Prior to this, he's held key credit and leadership roles in institutions, including Newtek Capital Bank and Windsor Advantage. He brings a disciplined, numbers-driven approach to deal structuring. And the way that I was able to connect with Goran is, I follow him on LinkedIn, and I just repeatedly was going back to some of his insights and just kind of his breakdown on, as everyone knows, SBA can hurt your head. And he just has a wealth of knowledge. And more importantly, I was just blown away by how quickly he was able to. I remember there was some new notice that came out, and I was trying to get my hands on it because it was very relevant to a deal I was working on. And within 10 minutes, he responded and explained it all to me. Nothing in it for him, just being, a good person and just part of this great small business community. So I'm really excited to have him here because he not only is a good person, but he really knows what he's talking about. And I think it's going to be a huge value add for people to be able to ask him questions and then also have this recording to go back to as we kind of progress in this new SBA SOP landscape. So with that, hand it over to you, Goran.
Charlie, I appreciate the introduction. So good evening, everyone. As Charlie said, I'm Goran Pavlovsky, founder and CEO of AWG Capital Advisory. I've spent the past 8 years in banking, focused on SBA lending and M&A transactions. Today, I work closely with business buyers, just like you, to structure and finance deals that not just close, but they hold up, create value, and stand the test of time. This presentation isn't just about what's changing in the SOP. It's about how the SBA is adjusting the view of risk, particularly in ownership transitions. Some rules are new, others are returning, but the direction is clear. If you understand the why behind the rules, you'll structure better deals and close with fewer surprises. And that's what we do here at AWG. When we talk about the full buyouts, let's start there. 100% change of ownership. The SOP continues to give you flexibility. You can structure the deal as a stock purchase or asset purchase. If it's a stock deal, the buyer and the target company are co-borrowers. This part hasn't changed at all, but it's worth reinforcing because the structure drives everything that follows. If it's an asset deal, the buyer forms a new co, and new co becomes the borrower. Simple enough. But remember, whoever owns that new co needs to be prepared to personally guarantee the loan, especially if they own more than 20% per the SBA rules. Equity injection. I think that's a very important topic, and there are some changes there. So SBA requires 10% equity injection, and that's based on total project costs. What SBA is really doing in the new SOP is reintroducing a rule from the old SOP 50-10-6. So for those of us who've been around in this space for a while, it's old news. So now at least 5% of the equity injection must come from the buyer or their investors. The SBA still allows a seller note to cover up to half of the equity injection, but that seller note needs to be on standby for 10 years. You can also stack on a second seller note on top of the first one, but then not use it for equity injection, right? It's just part of the actual capital stack. And that seller note doesn't have to be on 10-year standby. So now I'm gonna move the slide here to the visual flow chart, and I think it's good to pay attention there and follow through these changes, as we're going to talk about the partial changes of ownership, which I think are one of the most impacted changes now in the new SOP, right? This is where it gets interesting. Partial changes of ownership. When a buyer, let's say you go and you want to buy, let's say 85% of the stock, that transaction must be structured now as a stock purchase. The SBA has officially shut the door of multi-step workarounds, which, to be honest, were only around for a short window. And I think that was what Charlie was referring to. Charlie, you and I spoke about rollovers, right? Equity rollovers, which were introduced in December of 2024. A short time of 5 months, we had just to use them. Right now they're gone. And in plain terms, what SB is saying, we're done with backdoor rollovers, at least until the industry matures enough to handle equity rollovers the right way. It's a return to fundamentally and more simple and more transparent process, especially when we talk about keeping the simplicity in closing. And that's what SBA lenders typically want to see. They want to see a more simple process and less convoluted structures. So now in partial changes of ownership, if the seller is keeping less than 20%, and this is one of the key changes, they're required to personally guarantee the loan for at least 2 years. It's SBA's way of saying you need real skin in the game, Mr. Seller. And more importantly, you need to have built a business that can survive the transition. The SBA message is simple here, right? The business must be able to stand on its own and stay healthy for at least 2 years. And if it cannot do that, the deal probably shouldn't happen in the first place. Now, that might sound scary, right, for sellers to guarantee a loan at first, but here's the technical side, right? We can measure their exposure. The true exposure for the seller is just the first 24 monthly payments. Let's say worst case scenario, a buyer buys a deal, the seller guarantees the loan, the buyer doesn't make any payments in those 24 months, the seller has to cover those payments. But let's say the loan stays current through the initial period of 24 months, their guarantee is released after that, and they're off the hook. So when you calculate that portion, right, how much there is value at risk for the seller, technically is not the full loan amount, but is the 24 monthly payments that they will have to make if a buyer doesn't make them. So, and here's another shift. Any new investor in the ownership structure, in the partial change of ownership, is no longer passive. They are a co-borrower, so period. That's one or second biggest change, I would say, in the partial change of ownership. So the first one is the seller has to guarantee the loan. And the second one is that even if you have someone coming with you and owning 2% of the stock, they have to be co-borrower. So one last caveat. If you're buying a target, let's say, and you buy 85% of it, just remember, if it's an S Corp, only individuals and certain trusts can own shares. And that's where Charlie and his expertise also come into play. And if you plan to form a holdco, that will not work. So consult with your tax advisor and attorney before making that call if you're looking to buy stock of an S Corp in a partial change of ownership. So overall, SBA still remains the most effective tool for buying a business, but it comes with rules. And those rules, as we all know, are changing constantly. The key is to be intentional about your structure and get the LOI right the first time. So don't go back to the seller to renegotiate just because you were unaware of how the rules affect your structure. Save those changes for material issues later, not for things that could have been addressed upfront. Seller notes, they're still your friend. Well, now they have to be on full standby for 10 years when used as part of the equity injection. We don't see that disrupting the market in any meaningful way. It's simply a return to the old rules that were in place a few years ago. Overall, I think that SBA has tightened the reins on who carries the risk, especially in partial buyouts, as we see that they want the seller to carry a lot of that risk. And what they're doing now with the new SOP, right, it's a clear shift. If you want to do more structure, there's going to be more accountability and more parties will basically have to bear that risk. Our overall observation is that the best lenders and borrowers adapt quickly and adapt early. So, and these new rules aren't just a red tape. I think that they reflect SBA's shifting view of risk, just because the defaults have been on the rise in the past few years. And if we understand these rules right, and we keep a close eye on them, and we implement them in how we structure deals, we're going to still be able to close faster, and we're going to still be able to build strong businesses. So thank you for your time. I'm happy to answer any questions that you have, or talk about any specific deals or any specific scenarios that you have.
All right, that was great, Goran. Thank you so much. I'll kick it off. Could you maybe break down a little bit? I know you mentioned it, but just how to think about investors in this new SOP world. I know there's been kind of different things flying around. I don't know if you could kind of shed light on when you're bringing in investors, how to do that, how to think about investors from a equity injection requirements. Say you necessarily don't have the cash on hand to meet that that 10%, and the seller doesn't want to do a seller note. Kind of just maybe how you see bringing in investors. Has it changed? Or what is the same, and how to think about that moving forward?
Yeah. So probably if you have investors, right, that you're going to bring on board to close the deal, I wouldn't think about partial change of ownership, because that's where most of the complexities are now, Charlie. If you do partial change of ownership, everybody has to be a co-borrower, and the seller has to guarantee. So if we do a full buyout and we do it with asset purchase, the old rules are still on the table. That means, let's say you form a new co, you bring investors who own less than 20%. They're going to still be passive investors, and they will not be required to guarantee the loan nor be co-borrower. So that part doesn't change. However, if you want to do a partial buyout, then the investors will have to be co-borrowers. Same if you do a stock sale or stock purchase, and you form a holdco to buy the stock of the target company. Only the parties that own more than 20% of the holdco will be required to guarantee. So technically, if you're doing full buyout and the investors maintain less than 20% ownership, you're going to still be able to pitch that old presentation that you had even before the new SOP came into play. And let me know, Charlie, if that was not enough, and if you want us to drill deeper.
No, that makes a lot of sense. I think that's helpful to clarify for the group, because I know that there's been some things, and everything that I've read and seen, and like you just said, it really, that issue with the co-borrowers for investor really only comes into play at the partial change of ownership, if you're going that direction. So that's really helpful to clarify.
Absolutely. And while we're collecting questions, I want to reinforce how important it is to understand the seller note concept and the 10-year standby, right? We can have two separate seller notes, but if we use a seller note for equity injection, that 5%, right, that seller note must be on full standby for 10 years. Let's say we have another seller note. We have total of 20% seller note as part of the transaction. The remainder 15% doesn't have to be on standby for 10 years. So that's another big confusion that I see, that the clients are always asking me. And they ask me, okay, so what are the typical terms for the remainder seller note, right? And what I say is, still many lenders are going to ask for 2-year standby, just to allow you to transition successfully and become a CEO and feel comfortable with the monthly payments of the SBA loan. And after 2 years, typically a lender will allow you to make payments also on the seller note. So the seller note that is not used for equity injection, that typically is going to have 2-year standby requirement. However, sometimes if we have a strong acquisition, let's say we have strong and robust cash flow and stable EBITDA across 3 periods, we might be able to negotiate for our clients interest-only periods on that seller note.
Okay, great. And just for everyone, full standby. Some people have different, getting into this with full standby is no interest payments or no principal for 2 years.
No interest, no principal for 2 years. Let's say for the 10-year standby right, no principal, no interest payments for 10 years.
Are you, and I'm just curious because I know you see a lot of deal volume. Are you seeing seller, and maybe just it matters how large the seller note, what percentage of the overall purchase price, it is at the time, but are you seeing sellers be open to the idea? Because when of the 10-year full standby note, or are you seeing it, maybe if it's a huge note and they'll do, 5% or whatever, or do you kind of have any trends you're seeing in the wild, or is it too soon to tell?
Well, I can use my prior experience, Charlie, because just remember that this new rule was an old rule in 2020, 2019, and 2021.
Okay.
So I might be wrong about 2019, but I cannot remember exactly. We used to do deals where seller note has to be on 10-year standby. Let's say if you look at some of the portfolios of the banks of 2020, 21, you're going to see that those seller notes had to be on 5-year standby. Right now, as the rules are coming back, right, I have 2 deals, out of which one we issued a term sheet today with a seller note on 10-year standby, 5% of the total transaction. And then we have a second one that technically is being impacted by the new SBA rule. So the buyer is going back to renegotiate the transaction with the seller. So that transaction is $5 million roughly, and the seller note has to be $250,000, which will be on full standby for 10 years. So I think it's just a moment of reality check and also realignment of seller expectations. So what I tell sometimes in a joke, sellers got a little spoiled in the past few years since SB allowed those notes to be only on 2-year standby. Now that those rules are going back to 10-year standby requirement, I think it's going to be a moment of reality check and negotiation. But I don't think that a good deal where we have a well-aligned buyer and seller will die because of the 5% requirement. I'm pretty confident that there are mechanisms that can help the negotiations. And if any of you on the call come to that point where the seller is hesitant to provide a seller note on 10-year standby, I'll be happy to have a conversation with them and just lead them or bring them back in the history of how deals are done and what are the future expectations, because we see deals.
Great. And would you say from the buyer side too, have you seen a shift in the buyers that are, coming into the market, or, do you think that this is overall a good thing for serious buyers because it's, getting rid of, it's either going to require you having cash on hand or the ability to go out and get investors?
I think overall it's a healthy change, especially this about the equity injection. It's a healthy change for the ETA community because it's going to make sure that the serious clients remain on surface, because there was a lot of noise from clients that didn't have any equity injection nor had credibility to raise equity, and they were sending a lot of LOI, so it was creating a lot of frustration among the broker community, right? The sell side brokers community, and even good searchers were not able to get LOIs signed at that point. Now, let's say if even 10-20% of that community is no longer eligible to bid on these transactions, I think it's going to provide a path forward or clean the runway for qualified buyers. So I agree with that sentiment.
That's great. And please, anyone jump in the chat or just jump in the video, but I can talk all night. It's great to just be able to throw questions at you. I was curious, I was talking to someone recently about, pari passu loans, which for everyone, are for those that don't know, it's throwing a conventional loan on top of SBA. Do you see any impact on that, or just the general, I guess, risk tolerance for lenders as things tend to tighten, and maybe, the days of freewheeling, throwing out cash and, people not being as buttoned up are starting to kind of recede? I don't know if you've seen any other kind of impacts that maybe weren't mentioned in the SOP, but are kind of impacting the way that lenders approach deals, or just kind of their risk tolerance.
And you brought up a great point, Charlie. So when we talk about pari passu deals, we need to understand that they're typically deals where lenders will try to reduce their risk. So what does that mean? If a buyer qualifies for a $5 million SBA loan, doesn't mean that they will qualify for pari passu. Because if a lender has total exposure of $7 million once of a sudden instead of 5, that $2 million additional exposure is not guaranteed by the SBA. So how lenders get comfortable with that exposure is by having stronger clients and stronger buyers. What does that mean? Typically, the injection on those deals have been 10% or more. Typically, those deals are larger. Let's take, for example, a $10 million deal, right? You're going to have 10% injection at a minimum, potentially 20% seller note, and let's say 7 million SBA together with pari passu component. However, for that transaction to make sense, we're going to be cautious. Okay, what is the EBITDA multiple you're paying on it, right? The higher the EBITDA multiple, the lower the senior debt you're going to be able to obtain. Let's say for SaaS businesses, right? They trade at 6-7 times, sometimes even higher, right? For those businesses, and we've seen some of those, you have to raise more money compared to 3.5 multiple business, where it's much easier to get those done under pari passu transaction, because when we talk about funded debt to EBITDA, at that point it's going to be less than 3 times or 2.5 times if we assume that you're injecting equity and also seller notes. So overall, those are considered to be deals where lender pay much more attention on the guarantor strength, and some lenders will even require outside assets as collateral. Let's say, okay, do you have real estate to pledge to make sure we're protected for that unguaranteed exposure? And what else you can provide on the table to give us confidence that this transaction is right for you. Compared, let's say, if we have $3 million transaction, it's a different risk perspective and risk profile when we talk from lenders' perspective, and they're more willing to give chances even to buyers. Let's say they don't have such a strong personal financial statement. So overall, pari passu I haven't seen any change or any impact of the new SBA rule. So they're gonna still become or still remain transactions where lenders filter hardly.
Great. Very helpful. Okay, yeah, we've got Jesse here. Yeah, Jesse, go ahead with your question.
Okay, well, first, thank you for joining and sharing the knowledge. I appreciate getting upskilled. And I'm starting to look at like the types of businesses that I'm interested in. Facility, like they're like light manufacturing, like things in the B2B space, like very blue collar. Some of them are coming with real estate. And prior to this change, I'd learned about the option of, if the real estate is worth more than 51% of the transaction value, being able to use a 504 and a 7A combined, but getting the 504 amortization over for a longer period of time. Do these changes to the 7A impact the ability to use it with a 504, or change the rules around having real estate as part of a purchase transaction?
Well, thank you for the question, Jesse. So not necessarily. So when you have real estate, there are 3 options, right? The first option of a structure is there is one loan that combines the business purchase and the real estate, and then you're going to have a weighted average amortization based on the value of the real estate versus the value of the business acquisition. Or if 51% of the price is used or more is used for the real estate, then you're going to get 25-year amortization. What I tell my clients with that option, just be cautious. Make sure when you analyze the deal, you break down the transaction into 2 loans, because the business acquisition has to make sense on its own. Because if you're looking for a deal to cash flow based on 25 years, there is something wrong with the business itself. So I would split the business acquisition into a 10-year loan, and then the real estate into 25-year. What I'm going to be very careful about when I value the business itself, likely, and it happens very often that a buyer will forget to include a rent expense on the business side. And technically, by not including rent expense, you're understating the expenses and overstating the EBITDA when you value the business. So typically, what rent expense will look like, your monthly payment of the loan. So let's say you have $500,000 EBITDA, right? You have to pay $50,000 rent expense annually. Let's take that scenario. Make sure you adjust the EBITDA for valuation purposes from $500,000 to $450,000. Next scenario is to do the acquisition of the business, right? The purchase and the real estate with two separate loans, SBA 7A loans. And then the third scenario is to do 7A loan for the acquisition and 504, as you said, for the purchase of the real estate, and that is still feasible. For manufacturing, however, you can buy the business with a 7A loan and absorb the $5 million, the total loan amount, and also use the 504 to purchase the manufacturing building. Because SBA has those rules for manufacturing businesses where you can technically borrow more than $5 million of SBA funds. And you can, if you have such transaction and you need help to structure it and see how it's gonna look, I'll be happy to go in more detail about that. Just remember, for manufacturing, you can use SBA 7A loan for $5 million, and on top of that, you can get SBA 504, not related to that. Compared to some other buildings, let's say you're buying office space, you're buying a CPA firm with office space. The maximum exposure among the 7A and the 504 in that case is $5 million. But for manufacturing, it's different and it's better.
Thank you. I appreciate that.
Yep.
And Goran, just kind of going on, you're talking about structuring for everyone here, besides, this new SOP, maybe if you could just kind of, walk through what you think are best practices for, structuring and how to think about it and when to engage someone like you and how to kind of make sure that you're not, like you said, having to renegotiate on your LOI because structurally it's not compliant. And then, also maybe moving towards, at least I've seen, it takes a while before you get that initial blessing from lenders counsel for the actual structure. So kind of ways to mitigate that risk, because every lender can be slightly different. I don't know, just kind of some best practices on how to ensure that your structure is locked tight and not going to cause a last minute or midway through the deal renegotiation or retrade.
Yeah, that's a great point, Charlie. And that's the main point when we say to our clients, approach us before you send that LOI there. Because if there is any structural issue, A, eligibility issue, or B, anything that it works against you, we'll typically capture it. We're not lawyers, right? We're not Charlie, but from a structural perspective, from financial perspective, and from an SBA perspective, we'll catch the issue. Because that way, right? We use our own deal model, and I'll be happy to share it. We crunch the numbers quickly. We see where the transaction makes sense, because you might be willing because there is competition, and the broker on the other side is saying, "Hey, this bidder is offering this much money. If you don't offer that much, you will lose the deal." You might act emotionally, right, and offer that money. But even if you offer, let's say 90% cash at closing, it's going to be a waste of your time, because we can say, hey, Jesse or Charlie, this deal will likely not close because cash flow is too tight. This is so advantageous for the seller, but not for you. That's why it's best to come to us before LOI. We've had clients that have come to us after LOI, and with some of them have worked fine, but some of them have came to us once the deal didn't work with two other lenders and brokers. So we said, hey, reality check, we have to restructure this deal. Then we call their broker and say, Mr. Broker, I know that you've been waiting for 6 months for this buyer to be able to get financing, right? But guess what? They will never get financing if we don't restructure the deal. So we are very aggressive on that side, meaning we put, let's say, 80% of our resources on the front end versus 20% or 30% on brokering the deal. Because when we have a good LOI in place, when we already analyze the deal in-house, and when we have 7 to 10 pages of our internal analysis, it's very easy for us to broker the deal. But it's hard for us to broker the deal when we are throwing a curveball with an LOI that doesn't make sense first for you, right, as a buyer, and then it doesn't make sense for the lender also.
And kind of drilling down into that a little bit more, this might be a little bit more of a cart and the horse scenario, but do you recommend, and I'm always kind of curious how people approach this with, you have this conversation with the seller, you understand kind of what's their driving factor, whether they want, why are they trying to leave the business? Do they want a piece, kind of the psychology of the seller, if you will? And then do you recommend people come to someone like you who knows what they're doing from a SBA structuring perspective and say, this is how I think it will get done from what the seller wants, and maybe like a couple different options on how they see it penciling, and then you can kind of work through their model or their structure before they actually get into the guts of drafting an LOI or reaching out, using their template that they have of an LOI, or using a lawyer or whatever. I'm just curious kind of how you picture a really good process for people to come up with a really feasible but effective LOI.
Yeah. So for some of the buyers, because I think the zooming out of this will be helpful. For some of the buyers, we even are, if needed, we're going to jump on a call with the seller. So we're a true debt advisory. We're not just loan brokers, right? Debt advisory, we're going to advise you on the front end. If needed, we're going to help you negotiate with the seller. And just a few examples. Recently, we helped a client to get inventory as part of the deal, which they never thought it's going to be possible. We helped them negotiate a seller note. They never thought they were going to get it. We helped the client to reduce the purchase price, which they felt comfortable with initially. We say, hey, we are here to do good deals. What does it mean, right? We'll provide few scenarios for the seller. So together with our clients, we're going to say, if there is friction in the negotiation, then we're going to pause and say, okay, so what does the seller want here, right? If they want higher rent, if they're landlords, then okay, let's understand how should we approach that? Because remember, when the seller is a landlord, right, they own the real estate. Any increase in the real estate, any increase in the rent will increase the value of the real estate. So as a buyer, you should be aware of that, because that's a leverage you can use, right? Let's say increase of rent on a big manufacturing facility, and the rent increases by 100,000, which we had an actual case. Based on 5% cap, the value of the real estate increases by 2 million. So if the seller wants to get 2 million in value of the real estate, right, use that as a leverage to negotiate something for you. But Charlie, we help the clients to understand what the seller wants, because we do that daily. So we're very involved on the front end, and sometimes we can get on the call even with the broker saying, hey, there is a lot of back and forth. What needs to happen for the seller to get comfortable? And sometimes that's not possible, right? They're going to say, hey, we want this purchase price, and we know that that's not good for our client. We're gonna say, hey, Mr. Client, this is too much money for this business. Ultimately, you bear the risk of this deal, but if we were buying this business, we will not buy it. And by the way, for this transaction to close, we need 10% equity, we need 25% seller note. So the best thing is to approach us on the front end with the structure. We will not give you an exact valuation for a business, let's say in 24 hours. We're going to give you typically a range, and we want to play in that range. And if transaction goes out of the range, we had a short call today with a client. We worked a range. They were comfortable with the highest end of the range. They came back to us and said the seller asked 250,000 more. We said, no, we're not going with that, because that was out of the range, right? So we have to be disciplined. We have to be disciplined with the price, but that's why it's important to get those things done upfront, because when we have a firm transaction negotiated and signed, right, the LOI is non-binding, but it's so hard to renegotiate the price later on, right? You can renegotiate based on different EBITDA amount, based on the QOV findings, right? But let's say if you negotiate now a price of 5 million, and later on you go and say, hey, Mr. Seller, I'm not happy with the price. Actually, I changed my mind. You got to look at it as a very unserious buyer, right? Because if you want to retrade a deal later on, you have to have good arguments. And that's why we say, find a valuation that will make sense now, do the numbers upfront, and then move to post LOI due diligence when you know that the transaction is financeable. Because many of them that will be structured in a way of aggressiveness, they'll not be financeable. So technically, everybody is wasting their time.
Super helpful. And then kind of moving towards the second part of what you do with loan brokering, and maybe you can speak to this. Anecdotally, I've found sometimes with when folks try to get the best terms, try to say this the right way. Some of the banks that are offering really good terms might lack a robust team to facilitate a deal getting done quickly, or they're not as familiar with SBA loans. It's not like their primary kind of debt offering, service. So I was just curious how you think about, the lending brokerage side of the house, and what some things, whether people working with someone like you or going, on their own, how to think about engaging with a bank besides just the term sheet.
Yep. So I'll split that question in two components: the benefit of working with a debt advisory firm and the lenders we're working with typically. So we work with lenders who are typically top 50 or top 100 lenders. Will not go beyond that. The only reason why we might work with a lender that is, let's say, top 100 and 5 is because we know the leadership team, because probably they led a company that was top 30 lender and now they went to develop a different one. So that's why we're going to work. Otherwise, we work with lenders whose primary product, or at least they have a great understanding of SBA. That doesn't mean that all of them are built the same, and on the opposite, they're not. And here's why. Some of them, let's say, they provide the best pricing out there. That's A, because they have low cost of capital, and B, their infrastructure might not be that robust compared to someone that will price a little bit higher, but will get a deal done in 60 days compared to 90 or 100 days. So that's where the biggest difference come into place, right? Okay, I ask our clients, what are the most important features that these loans should have, right? Certainty to close, rate, or working capital line of credit. Let's say, because some lenders might be more stricter with working capital, and when someone says rate, I said, okay, so fine, we have lenders that are great for rates, but guess what? They're slower than other lenders. And I will not go in details why they're slower, but they are going to be slower, and they're going to be more conservative, right? So if your deal is a nice deal, let's say $4 million deal, and there is a $3 million loan, some of those lenders that are cheaper might not be a fit, because they might have in their internal credit policy saying that we're going to lend up to $2.5 million without collateral, but above $2.5 million, we need collateral. Some other lenders will say, okay, we don't like the industry, right? They provide great rate, but they're not a use for us in certain scenarios when we have an industry that they simply don't like. Is there anything bad with the deal? Not necessarily, but they've based on their portfolio management, maybe they've reached their exposure to that industry, or they've lent money in the industry in the past and they don't like that industry anymore. So I think there is a lender for each specific candidate. And an example is, okay, we had a deal. It was April 26, 27. We called the lender and said, hey, our client is being impacted by the new SBA rules. Can we bet that you're going to get the deal done and get an SBA loan number by May 31st? They said, no, we cannot. So we were proactive, right? Because the deal is being impacted by the new SBA rules. So we took that deal at a different lender. May 1st, we issued a term sheet. May 15th, we approved the loan. Internally, the lender approved it. Tomorrow, we expect to get an SBA loan number, right? It's very important to be strategic and to have an advocate. And that's why we come now to the second part of the question, right? Charlie, working with someone like us versus going directly to a lender. So when we talk about the seller, right? The seller is represented by their broker. The buyers are not that well represented because they typically will engage an attorney later in the process. So on one side, you have seller and broker, and the broker has done business in the past, right? They're probably somewhat good negotiator, let's assume, and you are doing this for the first time, right? There is high likelihood that they will not outsmart you, but they might outwise you. Let's put it that way. When we are part of the process, again, we see transactions every day, so we really take that fiduciary duty, and we really represent you as your debt advisor. So what happens, right? We work together with you to make sure that you get a good, fair price. You understand the net working capital component. We make sure that there is enough working capital in the loan proceeds, and making sure that we advocate for you no matter which lender we work with, right? Because tomorrow is a deadline for a loan to get approved, right? What we did today, we called a lender to go to their chief credit officer, right? To get an exception of one rule so our client can get approved. Likely, if you're working by yourself, I'm not saying that might not be an option, but we approach lenders from a perspective of someone that brings them deals regularly, and we have great relationship with our lenders, and we can ask for those favors. Those favors doesn't mean not complying with any rules. Those favors means that, okay, they can prioritize our deals, and they understand that whenever we bring deals and we ask for something, there is a reason we are doing that, right? We have to comply with the rules, all the rules, but we come from a perspective, okay, so we bring you, let's say this year, we might bring you 50 million to you, Mr. Lender. What can you do for us to make sure that our clients are feeling more privileged?
Great. And how, from a business model, you all get paid at the beginning, middle, or the end, or I don't know if you can speak to that, or
yeah. No, that's a great question, Charlie. And although we are debt advisory, right, we still get paid by the way the loan broker will get paid, right? We get finder's fee by the lender in this SBA transaction. Let's say if we have a $20 million private credit transaction, then we charge advisory fees, and typically they're tailored based on how heavy we need to lift on that solution. But in the SBA world, right, in the ETA world, we get paid by the lender. So
Perfect.
technically, there is no cost to our clients to work with us. It's the business model. I still think that the service we provide has value, tremendous value and price tag, but just because the industry works that way, and I'm an entrepreneur and I love to help other entrepreneurs, so we don't charge them.
Great. All right, I think we're getting towards the end. So I thank you so much, Goran. This has been really, really insightful. I guess, you know, and if you have any closing thoughts or comments, we can wrap it up after that. But thank you again so much. This has been incredibly informative. And I'll, Jesse, do you have one more question?
Yes, the infamous last question. Is there, even if working with a partner like yourself, is there a benefit to getting myself pre-approved for an SBA loan, to just be able to go to show brokers or sellers that I'm not a tire kicker and that I have a level of seriousness, even if I go plan to use somebody like yourself to help facilitate the actual debt?
Yeah, that's a great question. And we do that, Jesse, quite frequently for some of our clients. They're going to come to us and ask for a letter of support. Depending where they're in the process, when they're one of the top clients in the deal, right, we can go ahead and get a term sheet right away from a lender, basically, for that deal. We don't have to go for a pre-qualification letter, because pre-qualification letter, it's very light, I think, when lenders issue them. They're pre-approved for $5 million, but the lender doesn't state your personal and financial statement there, nor they state your liquidity position there. So what we do in our letter of support, we're gonna talk about your story, how your skill set aligns with the business. So that's the qualitative stuff, right? And then the quantitative stuff, we're gonna go ahead and analyze your personal and financial statement. And let's say you have, let's say, $200,000 in cash, and you plan to raise additional $500,000. We're gonna ask you questions and say, Jesse, how do you think you're gonna raise those equity, right? And Jesse will say, okay, so I have connections in the ETA world, and we're gonna ask those, and we're gonna write that in our letter, saying, okay, we have qualitative stuff now, quantitative stuff. We also added that Jesse is well connected in the community, so we give them faith that you will be able to raise that capital. However, if you're in front of a deal, we can go ahead and get a term sheet. So pre-qualification letter, again, I don't want to fully discount it. We can get those, and we've done it in the past. However, I think it's better when you approach a deal on a case-by-case basis, meaning you're providing something to a broker saying, okay, I'm a good fit for this deal, and not something that is cliche. Okay, this is the pre-qualification letter. By the way, the lender just issued it, but they might not even approve the deal. But from our standing point, we take the time, we analyze you, and we give them confidence. And we work actually with a lot of business brokers that will call us to get our thought even before they bring a deal on market.
Amazing. Thank you.
Yeah, you're welcome.
Thanks for that question, Jesse. All right, Goran. Yeah, any closing thoughts? And thanks again so much. This has been great.
Yes, it was a pleasure to speak in front of this group, Charlie. So thank you all for your service in the past, right? We love working with entrepreneurship. We love working with service members. So I would encourage you to reach out, at least connect on LinkedIn, right? And whenever you have a message, right, or you have a deal that you're looking at, here's my contact information. Send me an email. We typically will get our hands on deal within 24 to 48 hours to look at a SIM or tax returns or whatever we need to analyze. Our process is simple. We will first do an NDA with you, right? And then we're going to open a secure data room for you. And from there, we establish that relationship and we can work to analyze deals. We work with a lot of searchers pre-LOI. We have around 20 searchers that we actively work and help them get to term sheet. That's pretty standard number for now. So reach out on LinkedIn. Don't be shy. Even send a text message. I'll be happy to save your phone number, and stay sharp, right? Stay sharp. Just remember, when you're looking at deals, don't make emotional decisions. Just remember that you're going to be guaranteeing this loan, that it will be funding the acquisition. So try to stay rational. And if you're getting out of the rails, give us a call. We'll help you stay rational.
Terrific. Thank you so much. Talk soon.